Welcome to the Level 1 Derivatives Summary video series. This video is a summary of the reading on option markets and contracts. First, some terminology. A European call option gives the owner or the buyer, so these terms are used interchangeably, a buyer, owner, or the long position, the right but not the obligation to purchase 1 unit of the underlying asset at a specified price. This is also called the strike price and denoted by an X. Sometimes this is also called the exercise price at a specified time. That's the expiration of the call option. An American call option is essentially the same. The only difference is underlined over here, that it can be exercised at any time up to expiration. The reason it's called an option is because the long party has the option to exercise or not to exercise. A European put gives the buyer, the long position, the right but not the obligation to sell 1 unit of the underlying asset at a specified price, the strike price, at a specified time, which is expiration. And American put is similar, except that it can be exercised at any time until expiration. The option seller, also called the writer or the short position, incurs an obligation to perform under the option contract terms. So the short party has to deliver if the long party wants to exercise. You need to understand these payoff diagrams. So let's look at the most basic payoff diagram, which is the payoff for a long call. And what does payoff mean? Let's say that we are talking about payoff values at expiration. Here, x-axis is the stock price. Let's say you have a situation where you have a call option on a stock. The exercise price is 25, which means you have the right but not the obligation to buy the underlying for 25. If at expiration the underlying is at 20, will you exercise the option to buy for 25? The answer is no, because you can get the underlying for 20 in the market. If the underlying is for $30 in the market, which is what the x-axis here represents, then the call option is in the money. It is worth 5, and obviously you will exercise over here. So the payoff tells you how much you will gain or how much value you will have by exercising. So notice the payoff is essentially the stock price at expiration minus X. If the stock price is 30 and X is 25, then your payoff is 5. And if the stock price is less than 25, then it is 0. The payoff can never be negative. If you do exercise, that means that the option is in the money. So for a call option, if S is greater than X, the stock price is greater than exercise price, then we are in the money. If S is less than X, then we are out of the money. If S is equal to X, then we are at the money. So also note that this is a one-sided payoff. For the long, if the price is above X, there is payoff. If the price is less than X, then he doesn't need to pay anything. So this is called a one-sided payoff, as opposed to forward contracts and futures, where the payoff is double-sided. If the price goes up, the long wins. If the price goes down, the long loses. Also note that this is a zero-sum game. What that means is that whatever gain there is for the long is equal to the loss for the short, because the money is coming from the short. So the $5 that essentially are made by the long over here come from the short, so the short's loss will be 5. On the right, we are looking at put options. So let's take a similar scenario where the strike price is 25. A put option gives the long party the right to sell. If the stock price goes to 0, then the right to sell is very valuable. The right to sell for 25 has a payoff of 25. If the stock price goes to 20, then the right to sell for 25 gives you a payoff of 5. If the stock goes higher than 25, then there is no payoff. So the long will not exercise, so we are at 0. For a put option, if the stock price is less than exercise price, then we are in the money. If the stock price is equal to exercise price, at the money, and if stock price is greater than X, then we are out of the money. And this is the relationship for the payoff. Also note that the payoff for the short is exactly opposite compared to the payoff for the long. If you do get a question on the exam related to the short, I would encourage you to think like the long and then just change the sign. The short will be the opposite. Here are some simple payoff examples. If you have a stock index and the option contract has a multiplier of 500, the stock ends at 1100, price is 1000. So what's the payoff? It is the difference between the two, which is 100, multiplied by 500, which is given as your multiplier. And what is the put payoff? It is 0. The rest of the questions here are fairly self-explanatory, so you can look at them. Just note that with options, you can have several different kinds of underlying. Structure of global options markets. Options may be exchange traded, which means that they are standardized, regulated, backed by clearinghouse, or they might be over the counter, which means that they are customized, unregulated, and subject to counterparty risk. When they are exchange traded, then they are not subject to counterparty risk. So in some developed markets, such as the United States, there are actual options exchanges where options are bought and sold. In several other markets, options are not sold on an exchange, but you can go to a derivatives dealer and buy and sell options from the dealer. When you are engaging with a dealer, then we are saying that that is an over-the-counter market. There can be several types of options based on the underlying assets. For example, we can have commodity options where the underlying would be a commodity. Stock options, the underlying would be shares. Typically with stock options, the underlying is 100 shares. So the contract would be based on 100 shares. Or you can have index options where the underlying is an index, and there typically there will be some sort of a multiplier, either 250 or 500, and in your exam, if you do get a question, the multiplier will be given. You can have bond options where the underlying is a bond. You can have interest rate options where the payoff is based on market interest rates and strike rates. Now, as with forward contracts, the long party will gain if interest rates go up. This is for an interest rate call option. And then the payoff is calculated based on a notional principle. While this is part of your level 1 course, but I think the probability of being tested is relatively low because this material is covered in detail at level 2. I think you are more likely to be tested on just the basics of call options and put options. Interest rate caps are a series of interest rate call options. Buying a cap puts a cap or a maximum limit on an issuer's payment on a floating rate debt. So at this stage, I'll just have you remember this. This material is explained in more detail in the regular lecture. Floors are a series of interest rate put options. Selling a floor puts a minimum on an issuer's payment on a floating rate debt. Option value. Option value refers to how much an option is worth. It is also called the option premium or option price. Now, an important point here is the following. Let's say that you buy an option where you have a call option. The underlying is a share of General Electric. The strike price is 25. They are still 3 months to expiration, and let's say that the stock price is currently 26. Okay, so this is the scenario. If you could exercise today, what would your payoff be? The payoff would be equal to 1. This is a call option, so it would be 26 minus 25. But you believe the stock price will go up, and the market generally believes that the price will go up. So is the option worth 1 or more than 1? It should be worth more than 1. So the question is, in the market, how much are people willing to buy and sell the option for? That is called the option value. That's also called the option premium. It's also called the option price. So these three terms are used interchangeably. They are synonymous. So let's say that in the market the option is trading for $3. The intrinsic value is sort of like the payoff. It is how much you will get if you were to exercise today. If we go with the information that I've shared, what's the intrinsic value? It is 1. The time value then is simply the difference between 3 and 1. So 2 is the time value. And I've already pointed this out, but just to reinforce, intrinsic value refers to the payoff if the option is exercised. So the relationships here are the same relationships that we just saw earlier in the payoff diagrams. And then the time value, which is also called speculative value, because here we are speculating that the stock will go up and you will gain by holding on to the call option, refers to the difference between the option value and intrinsic value. And based on these simple numbers, hopefully you have understood and remembered the concept. What are the factors that impact the value of options? Options increase or decrease in value relative to several factors as shown in the table below. So let's look at the factors. If time to expiration increases, so two options are similar in all regards, same underlying, same strike price, but with option A we have more time to maturity. That will have a higher value because there is more time for the stock to go up. Similarly, higher time to maturity will also make put options more valuable. What if your exam question says that time to maturity or time to expiration is decreasing? Then what does that do to the value? That obviously does the opposite. That will decrease the value. It will decrease the value for both calls and puts. So in terms of time to expiration, the impact on calls and puts is the same. What about volatility of the price of the underlying assets? So both calls and puts benefit if the volatility goes up, because then the probability of making money on the option is more. So if you invest in options, take long positions, then volatility is your friend. Price of the underlying asset increases, so S goes up. What happens to the value of a call option? That's good, that goes up because the value of a call option is based on S minus X, so it's good. But the value of a put option goes down because a put is based on X minus S. So S goes up, the value of the put comes down. What about the exercise price? With a higher exercise price, a call option is saying that you have the right to buy at a high price. The right to buy at a high price is less valuable than the right to buy at a low price. So a higher exercise price reduces the value of a call but increases the value of a put. And the last point, just remember, if the risk-free rate goes up, that increases the value of a call but decreases the value of a put. You also need to know these minimum and maximum option values. These are also called bounds. In terms of an American call and an American put, the maximum that you will pay is the price of the stock. Clearly, you will not pay more than stock price for the right to buy that stock. So the max is easy to remember. But what about the minimum? And I'll help you remember this. Obviously, if the stock price is less than exercise price, then the minimum is 0. The minimum cannot be negative. So the minimum is either 0, or you can think of it as follows. So we are talking about a European option. It is S minus X. But we are doing the value now. So I'll just tell you what I mean by the now. So if this is time 0, option expires over here. And let's say now is small t. So we are here at this point in time. And we are saying that S is greater than X. With a European option, you can only exercise here at expiration. But you are trying to find the value at time t. So what you will do is S minus the present value of X. What's the present value of X? It will be X over 1 plus the risk-free rate to the power of big T minus small t. That's this time over here. Sometimes you might just see, instead of big T minus little t, you will see big T, which is referring to this time. Okay, so key point is it is 1 plus R raised to the power of time remaining to maturity expressed in years. So that is exactly what you see over here. S minus, and then the present value of X. So how do you remember this? With a call option, you can certainly remember S minus X. And then you can remember that we don't take X, we take the present value of X. So that is then 1 over R to the power of T minus T. So you remembered this. American call. Now remember, here at level 1, we are only talking about the bounds. Is it obvious that an American call must be worth at least as much as a European call? The answer is yes, because an American call allows you to exercise at expiration or before. So clearly it's worth at least as much, perhaps a little more. But if we are just talking about a lower bound, then it would be the same as the European call. It would be too complicated to figure out that slight additional amount, so we don't go there. So according to the curriculum and textbooks, this is the lower bound on the American call. What about a European put? With a European put, the value is going to be X minus S, but we can only exercise at expiration, so X has to be discounted. So again, 1 plus R to the power of T minus T. So the X is discounted and then minus the stock price. But here, the maximum value is also discounted. So why is the maximum value being discounted? What's the best that can happen with a put option? The best that can happen is that the stock price goes to 0. And when the stock price goes to 0, what will you get? You will get X. But when will you get X? You will get X at maturity. So if you are valuing over here at time small t, you need to discount back the X to your current point in time. And then the final is a put. American put. So here you have X minus S as the lower bound. Why do you not discount? You do not discount because you can exercise this at any point. You don't have to wait till maturity. Maximum value is X, because with an American put, if the stock price comes down to 0, then you will immediately exercise and make X. So how do you remember all this? You need to remember whether you are doing S minus X or X minus S. That's easy. And remember that you always discount X except with an American put. Okay, so hopefully that should be easy to remember. And another subtle point is that if there are cash flows or dividends associated with the underlying asset during the life of the contract, in other words, you have gone long on a call option and the underlying is a stock, and the stock is paying a dividend during the life of the option, then in all these formulas, instead of using the stock price, you use stock price minus the present value of dividends. And this material will be covered numerically and in detail at level 2. Put call parity. You need to understand that a protective put is equivalent to a fiduciary call, and this can be demonstrated, but I'll not do the demonstration. I'll simply give you the point that you need to know. A protective put is a share of a stock plus a put option on that stock with an exercise price of X. A fiduciary call is a zero coupon bond paying X at maturity and a call with an exercise price of X. This call is on the same stock, it matures at the same day as the put, and the exercise price is X, which is the same as the exercise price of the put. Plus, in a fiduciary call, you have a zero coupon bond with the same maturity as the put and the call. And obviously, if it is maturing and the face value is X, what's the present value? It is X over 1 plus R to the power of T, where T is the time till maturity. According to put call parity, the protective put is equal to the fiduciary call. If this condition doesn't hold, then we have an arbitrage opportunity, which we will discuss on the next slide. Now, what do these synthetic calls and synthetic puts mean? If you look at this relationship, you can then create a synthetic call by saying that a synthetic call is equal to S plus P minus X over 1 plus R to the power of T. A positive means that you are taking a long position, a negative means that you are taking a short position. A synthetic put P would be equal to C plus x over 1 plus r to the power of t minus s, and so on. So it is just basic algebra. Alright, the final point now, an arbitrage opportunity. If put call parity does not hold, there will be an arbitrage opportunity. To take advantage of an arbitrage opportunity, buy the underpriced portfolio and sell the overpriced portfolio. Classic rule of finance: buy low, sell high. So if you are given this data, which is from the curriculum, how much is the protective put worth? It's the stock, 99, plus the put option, so that is 103.25. How much is the covered call worth? It is the call plus the discounted value of x, and we are assuming that the t is 0.5. So this is actually, in the denominator you will have 1 plus 0.1 raised to the power of 0.5. So that's a edit. When you do that, you get 102.85. So how can you take advantage of this situation? You have to, so given that the two numbers are not the same, there is an arbitrage opportunity. Go long on the covered call, which means that you buy the call and the bond, and go short on the protective put, which means you short the stock and short the put. At t equal to 0, then you will make 40 cents. And what will happen at expiration? At expiration, no matter what happens, the payoff from the covered call will exactly match your commitment on the protective put. So you will be covered at maturity. So is this arbitrage? Yes, because at time 0, without taking any risk, you made money. And at maturity, what you get from the covered call is enough to cover the protective put. If you found this lecture helpful, then I'll be very grateful if you can do 3 things for me. Number 1, like this video. Number 2, like my Facebook page. And number 3, visit analystforum.com and there add my logo to your studying with profile. You can see this slide for help on how to do that. Thank you very much and good luck with your studies.